world's biggest tech companies, Amazon, Meta, Google, Microsoft, are all on track to spend more than $400 billion a year building out AI data centers by 2026. That's more than the Apollo space program cost in today's dollars, and it's happening every single year. Yet all that spending has only produced about $50 billion in revenue. That's an 8-to-1 gap, wider than the dot-com bubble ever was. And nearly $7 trillion in market value now hangs on that story. You don't need this to crash, you just need it to jilt, and everything from Wall Street to crypto feels it. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information, always do your own research. The scale is enormous, and this is where the bubble risk really begins to show. In the late 90s, during the dot-com boom, companies were spending roughly $100 billion on websites, fiber networks, all that sort of stuff, and they were making about $20 billion in revenue. That was a 5-to-1 gap. They spent 5 times more than they were earning. That was enough to blow up an entire decade worth of tech stocks. Fast forward to today, AI firms are spending more than $400 billion to make $50 billion in revenue. It's the same story, it's just bigger. The gap's now 8-to-1 instead of 5-to-1. And obviously that spending isn't going into profit-making products. It's going into compute, data centers, electricity, what's normally called CapEx, which means the growth showing up on the balance sheet is purely infrastructure, not earnings. And it's not that AI isn't real, it's that the economics have not caught up yet. Even inside the bubble, people know it's frothy.
And if we end up misspending a couple of $100 billion, I think that is going to be very unfortunate, obviously. But what I'd say is I actually think the risk is higher on the other side.
10 plus years, but I bet it's not more than 20 years. We're going to start building these giant gigawatt data centers in space.
The most powerful people in tech can see the bubble forming, but they're doubling down anyway because they know they have to. To stay relevant, to lead in this race, they simply have to invest, despite the fact there's going to be a bunch of casualties along the way. And the thing is, a lot of this growth isn't new money. It's the same dollars doing laps. And this is where the bubble risk gets really extreme. OpenAI raises billions of dollars, spends it on NVIDIA chips. NVIDIA invests that money back into OpenAI. Oracle finances both. That means they buy the same GPUs, they put them in their data centers, and this money just gets basically circled around from one company to another company, another company. It's capital inflating everybody's valuations. You'd be forgiven for thinking that kind of deal making sounds illegal. Usually it's completely illegal. In accounting, it's called round tripping, when one company recycles money to exaggerate profits or growth or demand. It's the same playbook Enron, yes, the famous Enron, used back in 2001, inflating revenue without creating any new value. The difference here is that these firms genuinely need what the other one has to offer. OpenAI needs chips, NVIDIA needs buyers, Oracle needs compute customers. So of course they're going to be linked. But when all of them rely on the same recycled money, the system becomes self-supporting. Like 𝗏𝗏𝗄𝗏𝗏 bridge, take out one beam, the whole structure will collapse. So in this case, it's obviously not fraud, but it's still fragility, because everyone's balance sheet depends on everyone else's optimism. And this is why this isn't just a tech story. The AI boom isn't some side theme of the market. It is the entire market. And if we've learned anything over the last few years, crypto follows the market at large. What's going on in traditional markets spills over into crypto. Crypto gets branded with the riskiest appetite brush. If risk isn't moving, there's almost no chance crypto and alts are going to move. Corporate America is spending hundreds of billions of dollars on AI infra every single year. That spending is driving GDP, earnings, and stocks. It's making them look healthy. And nothing shows that more clearly than NVIDIA. NVIDIA is the most expensive company in the world, worth more than $4.5 trillion now. Obviously, that's worth more than the entire crypto space combined, and nearly 7% of the S&P 500. NVIDIA literally is the market. It's made up an enormous portion of all the gains the SPX has made this year. A 10% move in NVIDIA is a $400 billion swing in equity. It's about the same size as JP Morgan. And this isn't theoretical volatility. NVIDIA's rise to the top has seen multiple 40% corrections along the way since 2019. Pullbacks are par for the course for a stock like this. And when one company gets that big, its normal volatility becomes systemic volatility. Now, in crypto, we do say volatility is a gift. It's par for the course and it provides excellent entry opportunities. But it's not just NVIDIA. Microsoft spends tens of billions on building AI capacity. Meta is also borrowing through off-book vehicles to fund its AI data centers. AMD and Oracle are locked in the same loop of investment and reciprocal equity stakes. These companies simply have to spend to keep up. And as they spend, they inflate each other's valuations. As each valuation increases, the risk of collapse becomes greater and greater. I'm not saying they're going to collapse tomorrow. At some point, probably something is going to break. Together, they make up the entire AI capex flywheel, one giant feedback loop that drives both earnings and market sentiment. If any of that machine stalls, liquidity across equities, credit, and crypto will tighten. And because crypto runs on the same liquidity that feeds AI, when AI is booming, risk appetite will be higher and capital will spill over into alts and speculative trades. But if AI slows, it's not rotation from AI to crypto, it will be contraction and contagion across everything. The risk isn't that AI is going to kill crypto, it's that the same AI bubble that keeps equities afloat is also what's keeping crypto alive. If that pillar wobbles, every risk asset is likely to feel it. And the point isn't that AI is going to collapse. It isn't like a doom porn situation. It's that too much of global growth, optimism, and liquidity relies on it working perfectly. And if it doesn't work perfectly, well, that's a problem. Maybe the spending does pay off. Maybe AI really grows into those valuations. But until it does, markets are priced for perfection, and perfection never lasts. AI is real, the gains in AI are real, but the reflexivity is back. Prices drive belief, and belief drives prices. Just like the dot-com era, the technology will endure. It's the market valuations that will probably struggle to live up to expectations. So if you're anywhere near risk assets, remember, the biggest risk right now probably isn't regulation or the Fed, it's the feedback loop built on hope, leverage, and a lot of GPUs. If that loop breaks, everything priced on future growth will feel it. So what am I doing? I'm not making any plays off the back of the fact there might be a bubble in AI. Who knows when the bubble's going to end? Who knows if there even is a bubble right now? I think we can probably agree based upon historical evidence, these numbers, these valuations, and this circular economy that's going on is a real risk and definitely could blow up at any point. However, for me, I'm just taking concentrated bets. Check out this show here on why I think taking concentrated bets is the best thing to do if you haven't got a massive portfolio. I'm still following perp detectors. I think the October 10 blow up pushed a lot of people out of that game. More people out of the game means it's easier to win because there's less competition. The ones I think best value to farm right now, 𝗏𝗏𝗏𝗏𝗏 and 𝗏𝗏𝗏𝗏𝗏𝗏. There's a spreadsheet in the description which tells you exactly the best ones to farm on any given week. Go check that out. I'm going to do another deep dive into perp dex farming and the best protocols to farm there soon. But as I said, I think there's a good chance that 𝗏𝗏𝗏𝗏𝗏 right now alongside 𝗏𝗏𝗏𝗏𝗏 are probably the two best to farm for the risk-adjusted returns. And I'm still building out a cash position ready to take advantage of days like we saw a few weeks ago and opportunities that come up. So I'm still building that cash position. I'm still holding my high conviction bets, and I'm still spending time farming protocols I think are going to pay when they tokenize. If you managed to watch to the end, thank you very much. Much appreciated. Also, leave a comment below. I always check all the comments. It's great to hear what you guys have been saying. Otherwise, I hope you have an excellent day. I shall see you in the next one.